Hey, it's Jim, and this is level 3 of the CFA program, the topic on portfolio management and wealth planning, and the learning module on a case study in risk management for institutional investors. I'm guessing that you guys know that the Institute and its program have evolved over the years. Readings have changed, learning modules have been added and deleted, LOSs have been changed. And I think as we're heading to the end of level 3 here, you probably have seen this in the last handful of learning modules. It used to be years ago that the Institute would focus on a return objective and a risk objective. And inside of the readings, it probably spent, roughly half the time on each. And inside of that return objective, there was very likely listed an actual return, like the return objective on this financial institution was 10% or some number, and then that had to be adjusted for inflation. But recently, the Institute has taken that kind of 50-50 trade-off, and maybe it's only about 20% now on return and 80% on risk. That's why we're doing a case study in risk management. Now, the Institute is going to call this the investment objective. So I think you'll be able to get away on the exam with kind of a general investment objective that relates to a return objective. For example, a pension fund might have an investment objective that sounds something like, hey, we want to meet all of the liabilities for the retired employees. Plus, we want to have a surplus so that when these people over here retire, then we'll have enough capital. So you got a sense that's kind of a general investment objective rather than saying, we need 7% and plus 3% inflation. But then the focus now, and I really am excited about this, the focus is now on risk management. So what did I say? About 80%. So what you'll see inside of this learning module is an investment objective that's kind of general, but then the risk profile or the risk objective or whatever the Institute is calling it is going to be a combination of what I've said to you in the past. Good wealth managers are part scientists and part artists. But the Institute is very clear in the beginning of this learning module. They say something like, look, this reading, we're throwing out standard deviation. We're throwing out value at risk. We're throwing out beta. We're not doing anything about the technical parts of risk. We've done that in level 1 and 2 and level 3. What we're going to focus now on is the qualitative part of risk management. And you'll see that through the illustration of a case. So we're going to do some discussing of risks, and then we're going to address those other LOSs through a case study. Then we'll do some enterprise risk management in the last 4 or 5 slides. So let's go ahead and start with that first LOS. So discuss financial risk. So I think the really great exam question, and I've said this to you guys before. Look, what's Jim's idea about risk management? Identify the risks, quantify the risks, and then manage the risks. So here, when the LOS says to discuss, I think the Institute is going to want you to identify one of these here on this page. And you know what these things are. We've talked about these multiple times, even going back to level 1. But then I think the more important question is then, what do we do about it? How do we manage these risks? One choice is just for us to say, we're accepting these risks. We don't really care about the consequences. Or the other extreme is that we're going to sign all these contracts, whether they're insurance contracts or derivative contracts that say we're completely transferring these risks. So you have those two ends of the spectrum, but very likely on the exam, those two ends of the spectrum are not going to be the correct answer. And so like many things that I've said to you guys over the years is that, this breaks down to our microeconomic analysis of marginal costs and marginal benefits. So I would be able to identify these risks, explain them, then discuss them in the context of the overall portfolio. Of course, market risk, when you think about market risk, you should automatically think of beta, but the focus here is not on beta as a measure of systematic or market risk, but the focus is on, let's say, a particular institutional client like a pension fund. All right, so we got this investment in equity securities. What do we expect that to be in 5 years? And then what could be the loss? Talk about variability inside of there. And that relates to our understanding of the financial markets. Now, liquidity risk, excuse me, this is super emphasized inside of the learning module, especially as it relates to institutional investors. And so this simply means that the institution has liquidity needs, like the pension fund manager, right? I mean, the pension fund has to distribute income to all of its retired workers, every day of the year. Maybe not every day, but, maybe bi-weekly or monthly. And so how do we fund that? Well, ideally, what we would do is we would invest in a bunch of dividend-paying stocks and a bunch of high coupon paying bonds, and all that income would exactly match the cash outflows. And so this liquidity risk is really a sense here of not only matching cash flows and cash inflows and cash outflows, but being certain, boy, that's a tough word there, being relatively certain that if dividends and coupon payments don't meet those obligations, then we're going to have to sell part of our portfolio there. So what does it read there? Sell investments quickly for a price that doesn't have to be discounted. Remember, you could sell anything if you give it a 50% discount. You could sell it today. And then some non-financial risks, operational risks. Here's the example that I give my students all the time. I'll go ahead and share it with you. Let's suppose we're a financial institution, and you are in charge of the ATMs, and you're forgetful. And so sometimes, maybe daily, the ATM runs out of $20 bills. And so you have these customers going in and they want a $20 bill and it's not there. So, those customers say, you know what, I'm not going to your bank, I'll go to some other bank. So operational risk, these are super important. Internal processes, people, and systems. Boy, if we allow our ATMs to run out of $20 bills, then that's a failure of all three of those, right? That's internal and people and systems. Reputational risk. You know this from listening to my advice about reading the Wall Street Journal every day. You see this regularly. Financial institutions and institutional investors worried about reputation, and make sure you have the link between the reputation and then loss of cash flows. The reading uses affecting its revenue, so that's why we put that on the slide. But I always tell students to write down cash flows. And then I'll have some other things to say about the ESG risks here in a few minutes, but this is super popular. Wall Street Journal writes about this all the time. And I'm certain you guys in the industry know about the kind of current events that are going on there. I'll have some commentary on that here in just a little bit. Now, this learning module emphasizes these three institutional investors. In fact, let me skip ahead here to one slide. Banks and insurance companies are excluded here. So I'm not terribly comfortable telling you just to not worry about banks and insurance companies, because we had another learning module on that earlier. So make sure you focus on that. But for this learning module, we're going to focus on pension funds, sovereign wealth funds, and endowments and foundations. So this is what I was telling you about just a few moments ago. Look at that objective. Very, very general. Provide retirement income, provide financial support, provide future financial support for the government. So that investment objective is kind of like the old time CFA return objective that's now referred to as an investment objective. So let me go ahead and repeat myself. I think you can get away with a general kind of an idea there, a general statement. But then the risk profile here is listed here as kind of general. But I think that when you see all of the slides that we have, that there's much more. What did I say earlier? 80%, much more to that risk. So notice that the very first word in each one of those risk profiles is the inability to do something. And let me go ahead and link this back to something that was brought up way back in level 1, is that we link this inability to whatever the board of that particular institutional investor decides is a reasonable level of risk and an investment objective. There's the slide on banks and insurance companies. And so here's a good slide on these financial risks associated with this portfolio strategy. So I want you to think about this. So here we are, we're an institution, whether we're a pension, an SWF or endowment or a foundation. And so we have these investment objectives. How do we pursue this, what the learning module calls sound financial risk management? Now, the good news is, of course, we've done this before throughout the CFA program. And so I would be able to not only discuss, but identify. I mean, these are really, I think, easy exam questions to write, and then should be easy ones to answer, in which, you're given this little paragraph inside of a vignette that says something like, here's the board, or here is the chief risk officer, or the chief investment officer, or this individual has commentary. And the commentary will say something like, oh, you know what, I think we ought to do some top-down stuff. I'm going to start with evaluating the Microsoft bonds and their duration. And you would say, wait a minute, that's bottom-up. That's not top-down. All right, so we identified that. That's the first part then. But then the second part, and I think this might even be more important, and maybe the better exam question, in which we say something like, all right, whether we're doing top-down or bottom-up, we need some kind of guidelines. We need to say something like, all right, so here is a list of, let's say, 4 items that we want to make sure that we cover, whether we're going from the bottom up or the top down, and let's go ahead and link them to each individual asset class, but in the context of the entire portfolio as well. You know about absolute versus relative risk. We've done this multiple times. I'll just tell you, what are those great examples of absolute risk? Something like standard deviation. Relative risk, something like beta. But what we're focused here then is the overall potential for loss. Remember, what was the goal back here? Let me just take this one here. Provide retirement income to plan participants. All right, so what absolute versus relative risk? If we want to talk about standard deviation and beta, which, by the way, we're not talking about inside of this learning module, but of course it relates to the whole context of risk management. But clearly, we need to take a step back and say, all right, here are the quantitative measures. Let's take a global view of what this means from a qualitative standpoint, in which we're relating this to, maybe a policy benchmark or some other kind of an item. How about portfolio level risk and asset class specific risk? This is an easy one. Just think of the overall portfolio, and what do we have? We essentially have 3 choices, right? We can advise our clients to invest in equities, fixed income securities, and alternative investments. So we have these three individual silos. So those things are going to be managed individually according to some kind of a strategy, and then it's the chief investment officer or the chief risk officer or somebody who's in charge of determining what's the correlation coefficient between and among those silos, and how does that relate to overall portfolio level of risk. Long and short-term risk metrics. Those of you who read the Wall Street Journal, you know that this is a battle all the time. How do we go about trying to determine which one is more important? If I go back here just quickly to the pension fund, we have this short-term obligation of meeting those pension expenses during the course of this month. But then we have all of these workers who are going to retire in the next 2 years. There's short versus long term. So make certain that you use the appropriate metrics to do that. Return base, we'll look at historical returns. Those holding base, we'll look at the individual securities. Maybe we'll even look at those individual silos. There's a box on quantitative versus qualitative risks. And then pre and post-investment risk assessment. You've heard me say this before. The Institute is very big, and I can't guarantee any questions, but somewhere in the Level 3 exam, the Institute is going to ask you to review and edit and evaluate and monitor and review. Did I say review? So that's really just the pre and post. So you're always going to say something like, we thought we had this much risk beforehand. So now at the end of this period, we look back and we say, we were exactly right. That's probably not going to be what shows up on the exam. What shows up on the exam is going to be something where, we were 75% right, and then we were 25% wrong. And the question is, identify that area of an error, and then let's make sure that we don't repeat it. All right, let's go ahead and look at some of these a little bit more carefully. So this is what I was saying about liquidity needs. So there are cash outflows in the blue, there are cash inflows in the purple. And so we need to make sure that we have enough cash inflows to meet all of those cash outflows. So I like this bottom part of the slide here. Liquidity needs may increase during a crisis because of increased payouts. Maybe we have early retirement if we're a pension fund, acceleration of capital calls, and then significant market movements. Of course, we need to worry about stock market and bond market and alternative investment crashes. And hopefully that we manage this liquidity in the way in which we have some kind of a buffer. I always think of that as a buffer. So inflows might decrease, distributions, liquid investments might become less liquid. That always holds true during stock market crashes. And so remember when we drew that normal distribution and we had the value at risk over on the way left side. Maybe we did it 5%, maybe we did it 1%, whatever that was down there. So we identified, kind of like the worst case scenario. And so clearly with sensitivity analysis and scenario analysis, as it can be applied to liquidity management, we need to make certain that we have a good buffer or we've invested in assets that we can convert to cash to meet all those cash outflows. Now, the question then becomes, well, Jim, you just told us we're going to have some alternative investments, so there's a list of some of them at the bottom. How do we manage the illiquidity of those alternative investments? And the answer is, well, we get something out of giving up that liquidity. And so hopefully, let's say, I'll just give you a quick example, the returns on our real estate investments during periods of inflation because rents are going up. So that extra compensation then will compensate us for some kind of a liquidity event or a market event or a process event or whatever it is, either in the private equity market or infrastructure market or whatever other alternative investment market there is. Here's a good slide for you to get your phone out and take a picture here. So discuss these financial risks. So we're continuing on in this kind of a strategy in terms of identifying, quantifying, and managing these risks. And so this is a little bit of a summary of what I have been saying so far and other things that we've talked about inside of Level 3. But a couple of interesting comments here. Of course, potential returns, right? I just said that. Committed capital is called unpredictably, and so there's the need for that buffer management kind of an Excel spreadsheet model, unpredictable cash flows, stale pricing. This applies to real estate. How many times do we sell our apartment building? Well, hardly ever. Or if we do it once every 2 or 5 or 10 years. So we have all of those problems with appraisals. You have the smoothing out effect, so there's less of a standard deviation. So you might be tempted to think that there's less volatility, but that's probably not true. So we call that stale pricing. So that's a good definition to know. Risk of over allocation in equity securities and fixed income securities because of all of these extra risks here. Costly rebalancing process. So that makes sense. So how about if we go into, let's talk about hedge funds and, private equity. There's this drawdown structure. We had this beautiful conversation on a learning module on hedge funds. So we have the limited partner and the general partner. So we have this drawdown here. So we need to make certain that all of our clients have the idea of, okay, I may be without this capital for quite some time. Yeah, so how do we do this? Look down at the bottom. Public market proxies. That's fine. Serial correlation structure. That's probably even a better strategy. Market liquidity risk, funding liquidity risk. These are two separate types of liquidity risk. Remember, what we want to do is sell the asset without having to put out a discount. So we call that liquidity. Embedded in there is that term, marketability. But funding liquidity risk is that we're not going to be able to meet those unexpected cash outflows. But also, there's also this kind of a general idea that if things don't go our way, someone might ask us for some extra collateral, and we might have to provide that collateral with some of our liquid assets, which then reduces our liquidity. I mean, it would be great if we all had, some tremendous famous diamond or pot of gold in our backyard, so we can always use that as collateral. But that's probably not the way it works. All right, what are the advantages of investing in these illiquid assets? So what did I say just earlier, right? Extra compensation. We're willing to take the extra risk just to because we're hoping for higher returns, right? But then we also have control. If we have this sole ownership, we have increased in portfolio liquidity, and then we have access to firm information, and then we don't have to pay the management fees, but we're at the risk of concentration, which then brings in the specter of a lack of diversification. We may not know as much as we thought we did. There's this idea of hubris. I mean, this is pervasive, everywhere you go, but clearly in the primary and secondary markets, in which we always say, we're tempted to say something, like I'm pretty smart, and that person over there, they're not very smart. I'm going to take over that company, or I'm going to make that particular investment, or whatever it is. And then when you find out all the marginal costs and marginal benefits that you were unaware of, well, then you're thinking, gosh, maybe I'm not as smart as I used to be. And then we have to worry about reputational risks. How about the indirect advantages here? So this would probably be managed by a third party. So there's going to be some more diversification. That makes more sense. Limited liability, outsourcing. What are the things we don't like about it? Less control, way less control. We probably don't have the information. Less portfolio liquidity. We probably have to pay the fees, and then uncertain timing. So how do we manage this? So look down at the bottom there. We put in an emergency plan. This is what I was talking about earlier with this, kind of a buffer. And so the buffer management, as I call it, this thing might explode and it might shrink, so that emergency plan. Stress test, we've talked about that at length in previous recordings. I always, the way I teach this into my students is that we put an Excel spreadsheet together, and if we're computing, let's say, net present value for a corporation down at the bottom, it turns out to be positive for all of our expected values up top. And I'll just have them put some crazy numbers up there. I'll say, oh, you think revenues are going to be 100 next year. Suppose they're only going to be 20. Let's do that stress test and see what the net present value turns out to be. And of course, you can put together some kind of a massive Excel spreadsheet to do this stress test, which then leads you right into that cash flow model, and then those liquidity risk parameters. And so, I'm not quite sure what the correct chronology is here in this one. The Institute puts it, in that form from top to bottom, but I'm not sure you can't do it the other way around. The chronology of this is probably not as important as the context of it and how you can apply the management, because I don't imagine that the Institute would ask you to do all four of these things on a question. They'll probably say something like, hey, we've done this. What's the next step? Or what would you recommend? Or what else can we do? And the answer would probably be one of the other three, probably not all of the other three. Now, remember at the very beginning, I made a comment. I said I'll have some commentary later on about this ESG stuff. So I want you to just take a step back here and listen to what I'm trying to get to you guys so that you can answer these questions correctly on the exam. This ESG world has taken on, kind of a mind of its own. It has evolved in and of itself. So I imagine that some of you out there are on one extreme where you're very concerned about the earth warming. And some of you are on the other extreme where you're saying something like, this might be made up, or what, we're getting a little bit hotter, but the consequences are not that great. Well, the Institute over the years has tried very hard to, remain, outside of the political environment. But here, clearly we're diving into this because you have politicians who are, essentially in control over all this stuff. So here's my advice on the exam. I don't think the correct exam answers would be something like, the earth is burning and we need to do something dramatic today, like, carbon capture and trading and carbon credits and high taxes. Or I don't think the correct answer is going to be, we don't really need to do anything, everything's going to be fine. I think the answer is going to be somewhere in the middle. So I want you to kind of approach these next slides as, all right, the Institute believes that this is an important risk. So how do we identify it? How do we manage it? Or how do we quantify it? And then how do we manage it? So I think if you take that kind of middle of the road perspective and think of environmental and social risks in the context of all the other risks, think about those risks that we listed at the beginning of this slide deck. I think you'll be able to answer these questions correctly. And so just remove the politics from it, remove kind of your own personal thoughts about it, and I think you'll be okay. All right, so the idea here behind these environmental and social consequences is that, when a corporation is pursuing its objective, which is to maximize shareholder wealth, there are consequences to its behavior. I mean, the obvious one is pollution. In where I live, we have a local, really, really awesome golf course that was built right near an electric plant, an electricity facility that uses coal, and now it's moving away from coal. And when you're on this golf course, you can see the big smokestack, and the white smoke is coming out of the smokestack. I'm guessing that it used to be black smoke, but now it's white smoke. So clearly the obvious one is pollution, but there are all other sets of externalities. Remember, there are positive externalities and there are negative externalities. And so look for questions on the exam about these consequences that are imposed or enjoyed by society, whether they're positive or negative. So here's this idea of responsible investment. Remember, going back to the 1930s and the 1940s, there was the prudent investor rule. So apply that kind of a thought process to responsible investing. And so the key word is sustainability here. What kind of an earth, what kind of an atmosphere, what kind of quality of air, what kind of quality of water, what kind of quality of food do we want? So we want this responsible investing so that as good wealth managers that we advise our institutional clients to pursue these kinds of responsible investments. So there have to be guidelines. There has to be a way. Look at that top right box there. There has to be a way. And I'm going back to marginal cost, marginal benefit kind of analysis. What we could do is internalize the price of these negative externalities. But when the Institute says internalize negative externalities, it's also implying to internalize the positive externalities in there, which may be more difficult to do. So marry that blue box there with the red box in the middle, and then also the green box down on the bottom left. Now, what does this mean in terms of dollars? Look at this: higher insurance premiums, higher taxes, inflated input prices. So what this means is that there are negative consequences that relate to the entire economy. Can we internalize them and somehow turn them into positive cash flows? That's really the ultimate goal here. And remember that this responsible investing, at least from my perspective, this is not a next week thing. This is a next century thing. And so I think the Institute is taking the position of, we're going to do this incrementally as we go along, try to figure out what all of those marginal costs and marginal benefits are. These physical climate risks, you guys know this from watching the Weather Channel, storms, rising sea levels, temperatures. It might become the new norm. I'm not sure we're certain about all that, but clearly if there is a permanent rise in temperature, this is going to have clearly dramatic effects on economies and investments, in particular like real estate, in particular like infrastructure. And so, on the one hand, if you have a weather event, if you have a climate related event that, let's just say raises sea levels and it submerges a bridge, let me just take a quick example here. Well, then we're going to have to rebuild the bridge. So we want to make certain that we're investing in companies or investing in entities who are able to meet those new needs, because that new bridge is going to be able to have to withstand higher temperatures, stronger waves, all that kind of good stuff. So there's potential for tremendous returns in this area. Now, here's the big word. Wall Street Journal uses this all the time. The Institute does as well. This transition from, fossil fuels to renewable stuff. And there are marginal costs and marginal benefits with both of these here. So, here once again, we go back into the politics of this, so who's in charge of the government? Are there people who are on the one end of the spectrum, like I described earlier, or are there individuals on the other end of the spectrum? So we may get carbon limits, we may get carbon taxes, but who knows? We may elect a bunch of House of Representatives and senators who are at one end or the other of the spectrum, which then says, hey, you know what? Who knows what's going to happen? So I think this is a really good exam question. The exam question is, hey, here's an election. We, the people either on this side or this side now have majority control of the Congress or the House or the White House, whatever it is. What are kind of the consequences? What do you suspect is going to happen? Now, regardless of the politics here, everybody, both the liberals and conservatives, are interested in clean technologies. Of course, we're interested in less pollution. I mean, I've never really met anybody who is in favor of pollution, at least on a grand scale. So we're going to move to these cleaner technologies, and this is a good thing, right? But it does mean that we might have higher input costs. So here's that marginal cost, marginal benefit. So I can't help but think the Institute is going to allow you guys to say something about marginal costs and marginal benefits. And there's shifts in consumer preferences. What's that wealthy guy's name? He does the rockets. He does the little thing on your phone that I never do. Shifts in consumer preferences. 2 years ago, driving around, I don't even know if I recognized a Tesla, but now I see the Tesla people driving around, or I guess you could say being driven around. So here's a good slide on marginal benefits, right? Climate opportunities, right? Absolute new investment possibilities. Imagine if you're a scientist and you came up with a machine that could take gallons of seawater and put it in the machine and do whatever it is that you can do with it and turn it into either drinkable water or water that could be used for bathing or irrigation. I mean, imagine how valuable that machine would be to turn, entire countries or even entire continents from deserts into, productive farms. I mean, how awesome would that be? So that's that new investment possibilities. Renewable energy, clearly we have all of these good opportunities. When my family and I go on vacation, we drive over a dam. You look over here and there's tons of water, and you look down there and there's no water down there. So that hydro plant is producing tons and tons of electricity. So traditional technologies this hydro dam has been there maybe my entire life, probably not that long. But, so we've been doing this for a long time, but probably we could figure out how to do it more efficiently. And so there we got the top right up in the orange. Yeah, investors are going to be way more interested. All right, so material social issues. So what do we have to worry about? Community relations, good corporate behavior, labor issues. This is a big one here, especially given the context of what we had during COVID was this, just terrible breaking of the supply chain. I remember reading in the Wall Street Journal that we had, I'm going to make this number up, we had thousands of ships out there in the Pacific Ocean just waiting to dock, but there was nobody there to unload all this stuff. So we didn't have medicine, we didn't have shampoo, we didn't have crackers, we didn't have whatever it is that we were, trying to import. So that supply chain, that's probably a really, really good question, I think. How about labor and unions and how it relates to labor exploitation? Of course, nobody wants to see 10-year-olds working 20-hour shifts in a factory. Sustainable development. There we go. Balance the current needs without compromising future generations. So here is the Institute's way of using my terminology: marginal costs and marginal benefits, economic growth, and social justice. All right, so here we get into the case. And I encourage you to pay attention here during this, but I really want you to go back to the learning module and work through the case. It's a bunch of pages. It'll take you a while, but I think the most important part of that is that there are 5, maybe 6 pages of a dialogue between and among some really important people that are making some investment decisions. And, the Institute, this is not going to make for good language in a Hollywood movie, but clearly there's some really interesting things in there about how individuals think, about how they're managing risk. So I think that's a great exam question. Now, we don't replicate that here in the slide deck because it would just take too long. But I want you to go back and read through all the comments. And then at the very end of the case, there's just a couple paragraphs of a summary. So I think a great exam question would be for the Institute to have, half a page of dialogue and then have you interpret it. Here we have a case study: direct investment sovereign wealth fund of Volvania. That's a cool name. My father bought a Volvo back when I was in high school. That was really cool to drive around a stick shift. Can you guys drive stick shifts these days? All right, here's the case background. Discovery of large reserves of lithium. We formed this sovereign wealth fund to ensure future generation prosperity. There's a very general investment objective. Converting non-renewable assets into diverse financial assets. Oh, so look at that far right over there. Diversification across all these different asset classes that we have discussed. So here's this case study structure. We'll look at scene 1 first. Current investment committee meeting for 2 new potential investments. And then we'll go ahead and skip ahead 3 years from now and take a look at a current event. This is probably very likely that the Institute will do this to you in your essay portion of the exam, where you'll have, a bunch of questions that say, all right, here's a bunch of stuff. And then 3 years or 5 years or 20 years later, then here's a bunch of other stuff. All right, so here we go. Direct investment in a seaport, that's investment 1. And then direct private equity investment in an electric vehicle company. All right, so scene 1, we're going to have this meeting for 2 new potential investments. We're the wealth advisor for this sovereign wealth fund. Here we go. The Gulfport Seaport, developing market, an island with rich marine ecosystem, 120 million in a public-private partnership. So there's the infrastructure, 27 years, expected internal rate of return of 14%. 14% sounds like a great return to me. Dock would be located 100 or 1.5 kilometers from the ocean. Here being in the United States, I have no idea how far that is. That could be 100 miles or it could be a half a mile. Probably somewhere in between there. So, all right, so 600 million. Anticipated to handle 12 million metric tons of goods per year. I have no idea what that means. 12 million metric tons sounds like a lot. There's a group providing 40 million in funding, non-recourse project finance, 360 million, 17 years with a 2-year grace period. Remember that non-recourse means that if this fails, then they can't come in and take everything else that we own, right? Remember, a mortgage loan is a non-recourse loan. If you fail on your mortgage payments, the bank can't come in and take your car or your retirement or your children away from you, but they can come in and move into your basement. 2-year construction, 27-year concessions, and so those concessions are something like, well, you know what, if you build this, it ought to work. Quality standards and performance standards. All right, so look at that LOS. Analyze and evaluate financial and non-financial risks. So we've done all that in the first part of this slide deck. So what are we doing here? We've got currency risks. Even though we're going to predominantly generate revenue and cash flow in dollars, we might need to manage this through some kind of insurance contract or a derivative contract. We're going to borrow in dollars, but there'll be some local borrowing in there, so we need to worry about that. Default risk, there's always default risk, but the non-recourse component of that loan then, kind of reduces that liability. Yeah, that 14%, of course, IRR may not be realized. This is what I tell my students all the time. I say, look, anybody can invest in a positive NPV project or a project in which the IRR is greater than the weighted average cost of capital. But it's another thing to make certain that happens. Remember, when you compute NPV and IRR, those are estimated cash flows. Well, you can be tremendously optimistic in the estimation of higher revenues and lower operating expenses. But then this is why the executives make so much money. They make certain that all of those numbers come in. That's why we talk about budgets and delays and penalties. So that's an easy answer there. If they tell you about budget overruns and penalties. Those of you who live in the Massachusetts area, and I'm not even sure this thing is done in the early 2020s. Was it, 2 decades ago they decided to build the Big Dig? I'm pretty sure the Big Dig is done, but I'm not sure that it's completed, whatever that means. So we have to worry about recessions, and we need to worry about pandemics. My wife just said to me the other day, she read on her phone, there's something called Disease X out there, whatever that thing is. And I told her, I said, bring it on. Bring it on. I had COVID multiple times. Whatever they got, I'm ready to handle. So, all right. How about non-financial risk? So we just talked about climate. Well, remember, we're located near the ocean. Probably not 100 miles, like I said. It's probably closer to a mile or so. So rising sea levels, and that's probably not the most dangerous aspect of climate risk. But do we have extra hurricanes? Do we have tornadoes? Do we have scenarios under which the storm, whether or not the sea levels are rising, whether that storm surge comes into the land and ruins all of our infrastructure? We haven't talked much about political risk. I haven't called it political risk yet, although that's been embedded in kind of our conversation here. Whenever you go and build something in another country, you have to get permission, right? There are zoning requirements and laws and regulations and all sorts of stuff. And those policies and regulations are determined by the regulators or the politicians in that area, so that can change all the time. So we need to make certain that we go over to the local political office and say, hey, hey, I'm Jim. I'm a nice guy. I'm trying to help out. How can we work together? And then that probably be okay. Yeah, sector correlation risk. So we've got this located here. We've got this located here. So we're probably not as diversified as we could be with this investment. So let's just make sure that we are aware of this correlation risk, and then environments there. We talked about that before. All right, how about an investment in Volta Motors? Let's see, it's Frontier Market of Metropia. There's some financial information. A landlocked nation, nearest port is through river transportation. So we're gonna invest $30 million for a 40% stake. So modernization will allow us to expand into new EV models. Let's see, 35% reduction in labor headcount because of efficiency and modernization. We need to worry about being near a river. That's critical for supply chain. But suppose, here, let me give you just a stupid example. Suppose a team of beavers comes in and they build a dam right upstream, and the water doesn't flow down, so we can't get all of our supply. And then people come by and they look at the beavers and they say, "Oh, they're so cute. Let's just wait, and then let's wait till they have a family, and then we'll transport them somewhere else." So you have this temporary interruption of the supply chain. We get 2 board seats down there at the bottom. All right, what are the financial risks? So we have a handful of these as well. Technology development risks. from my perspective, I'm thinking of an Excel spreadsheet, successful development and implementation, technological difficulties. So what this means is that this is going to impact the operating, let me just call them operating expenses in our cash flow statement. Market adoption risks. This really depends on whether or not individuals want to drive electric vehicles. Now, governments could throw in a subsidy and say something like, hey, you know what, if you buy this electric vehicle for at least $60,000, we'll give you a tax break of $2,000 or $10,000 or $20,000 or $60,000. I mean, the government can do, whatever it wants. And so, clearly, if the government said, we'll give you a $60,000 tax break, then tons and tons of people will demand these electric vehicles, and then that'll work its way down the supply chain. So that would be all good news, right? Currency risk, we know about that. Default risk, yes, we know about that. Economic risk, cost savings risk, and foreign competition risk. And so that cost saving and foreign competition, that relates to the Excel spreadsheet, both on the revenue side and the operating expenses side. How about non-financial risks, reputation, political, and management risk? Those make perfect sense. Supply chain. There's pandemic, so this is really just, the latest iteration of the Institute, which, has claimed historically, it's not, you're never going to be tested on current events, but clearly it's influenced by current events because, look at the 2008 financial crisis, so those are good testable materials, not specific to 2008, but just, kind of a general crisis. And so I wouldn't be surprised on the exam, because the Institute emphasizes it in this learning module, for it to say something like, oh, there's a virus, call it, whatever it is, virus Q or something out there. And this is going to do all of these things. And so remember, this is going to impact cash flows. Sector concentration, we talked about that a little bit ago. All right, so how about if we skip ahead 3 years, this seaport infrastructure project. So we've completed, no major cost overruns, positive feedback, grand opening. But we do have rising management fees from this operating group, which is not surprising. It's never a scenario under which many management fees fall, although in some cases they do. What about climate change? So the new dock is only 1.5 kilometers. Concerns about storms, hurricanes, tornadoes, rising sea levels, hotter temperatures. All right, so what are the risks here? Lower seaport traffic, service quality, higher operating and maintenance costs, risk of default, expropriation. There's a good political risk. I always teach my students, I give them mathematical examples. This is in the intermediate finance class. I give them mathematical examples on blocked funds, which is, limits to repatriation, and then how to deal with expropriation. And this is a great way to combine probability theory. And we say something like, there's a 10% chance that the assets are going to be expropriated, and the entity will be compensated at 90% of its book value or something like that. So worry about expropriation, and don't forget limits on repatriation as well. So currency risks, interest rate risks, climate risks. So we've talked about all those kinds of things. So here's the great exam question here. So we identify the risk, but how do we manage these? How do we mitigate these kinds of risks? All right, so let's increase our marketing efforts, lower seaport traffic than estimated. Regularly review traffic forecasts, adjust strategies as needed. That's all part of the editing and reviewing and monitoring that the Institute is so big on. Look at the next one there, monitoring of service, customer feedback. This is all part of that process that I've been telling you about for multiple learning modules. Regular audits and cost control. So look at this right here. Think about the Excel spreadsheet. You got revenues and operating expenses, and you could have a list of maybe 20 different operating expenses. But each one of those operating expenses and the revenues, they're going to relate to either the green or the purple or the blue, or this blue, risk of default, expropriation, currency translation. So what do we do about the risk of default? Well, I mean, there are all different sorts of ways, but what we do is we say something like, we're going to make certain that you guys are in an economic environment and a managerial environment where you can make these payments. But if we need a new operator, then we have plan B, right? So this is similar to the buffer that I was talking about earlier in the slide deck, but the buffer, instead of meeting the liquidity needs, the buffer over here is going to meet this seamless transition if we're faced with this risk of default. What do we do about the threat of expropriation? Well, we have lots and lots of lawyers and legal experts that say something like, hey, what international law says the following, right? So if so-and-so happens, if such and such occurs, then we have these courses of action. But there's that first one. This is what I was saying earlier, positive relations with the government. What did I say earlier? Go introduce yourself. Hey, I'm Jim. I'm trying to help out. Let's make this work together. This is what I was saying in the orange there, hedging financial risk. We can do this through insurance contracts or derivative securities or any other kind of a model. Now remember, this was a several decade project. And so don't be intimidated by saying something like, hey, you know what, let's go ahead and use a currency swap. Remember, that's nothing more than a series of forward contracts. So you sign this swap contract today. Maybe it has a tenor of 5 years, maybe it has a tenor of 7 years, and then you don't really have to worry much about currency risk over that time period. Although you don't put the swap contract on hold and leave it up there, you need to make sure that you monitor it. And then what do we do about climate risk? Well, this is just what we've talked about before, what you're reading about in the Wall Street Journal, what you read about in other parts of the CFA program. We need to, band together to try to fix this problem. All right, how about the Motors project? So the establishment is complete. Economic downturn, increased competition. We need to reduce the workforce as part of our cost-cutting measures. I just read in the Wall Street Journal that some big firm, I won't mention it, some big firm, you guys know who I'm talking about, took over a gaming company and is laying off a couple thousand workers. So this is common workforce reduction. All right, so what about the environmental concerns? Allegedly dumping waste in a nearby river, impacting local biodiversity. This is no good. Now, remember I said earlier, I don't know anybody who is in favor of polluting except for, remember I said except for? Well, here we go. So if we're dumping waste in nearby river, what does that mean? We are absolutely trying to maximize shareholder wealth by lowering our costs, because we'd have to take the waste and do something else with it and maybe pay somebody, right? So we're trying to maximize our cash flows, but then we have all of these other risks that we're exposed to, not least of which is reputation risk. All someone has to do is take a picture of our board members, standing with a bucket and dumping, this toxic waste into the river and put it on the front page of every newspaper in the world. Do you guys even read newspapers anymore? Put it all over social media, and all of a sudden, we're the bad guys, and that's not what we want, So if we have these environmental concerns, then the competition is going to eat us up, right? Market shifts, local management risk, expropriation, currency translation, climate risk. All of these things here are a function and are increased risks of making just one poor decision. Now, here's another good slide to go ahead and take a picture of. I could spend probably 30 minutes going through each of those risks down the left-hand column, but I'm not going to do that. I'll just emphasize a couple of things, those mitigation measures. I think these are really, really good, really super good exam questions. So we identify the risks over on the other side. Look at the obvious one. We just talked about this right in the middle there, expropriate risk. What do? Maintain open communication, right? Currency translation risk. We need to be aware of an economic downturn. We need to make sure that we know about all the derivative contracts that are out there. So take a picture of this, read through all those. These are just a summary of what we've been talking about throughout this slide deck. All right, let's move on to this last LOS here, overview of enterprise risk management. Let me give you just a quick history lesson. This has been around for decades, but it became super popular after the 2008 financial crisis, mostly because individual investors, institutional investors, and everybody else out there that was concerned about the economy found firsthand that when you have a crash, that correlation coefficients, which we were depending on to give us diversification benefits, they all moved together and they moved to 1. And so this enterprise risk management is kind of like, I don't want to use the word holistic, but, enterprise-wide risk management, so the entire enterprise. So you have these individual silos, like I said earlier in this slide deck. And so, we're managing these individual silos, but then somebody has to be in charge, like a chief risk officer has to be in charge of how these different silos behave against each other. So the focus here is to evaluate strengths and weaknesses and then recommend improvements. So we're going to identify and then we're going to make some kind of recommendations, which is pretty much what we've been doing throughout the CFA program. Now, you've heard me say this multiple times. So institutions, they have a board of directors or a board of trustees. So they establish those parameters for risk tolerance. What that means then is that we, as good wealth advisors, can identify and set a strategic asset allocation. And remember, we're probably going to do something like a range. We're not going to say, hey, equities are 42.6%. We're going to say equities are 38% to 49%, so that it gives some room for just regular old market fluctuations. But then it gives us some wiggle room, extra wiggle room, for tactical asset allocation to take advantage of short-term market imperfections. So what are we worrying about? We're worrying about volatility, we're worried about drawdowns, and we're worried about value at risk. So how do we define these risk parameters? These things go into the policy statement. Now, in the old days, remember I was saying to you earlier that the Institute was very big on a risk objective and a return objective. This has been kind of summarized by an investment objective, but we have all of these different constraints. So these risk parameters depend on the constraints. So remember, we've got a liquidity constraint. So there's a liquidity risk. We have a tax constraint. So there is tax constraint. So there are time horizon constraints. So there are, let's do this, credit risk guidelines there, active risk limits. Those would fall under a couple of different categories, but investment horizon as well. And then I always throw behavioral issues in there for my students. I use that as a separate constraint, but here the Institute is calling these ethical investment criteria. So that would include behavioral stuff as well. So think about those risk parameters being identified and set pretty much by the board, and then what those investment objectives are going to be. All right, so the investment team executes the strategic asset allocation. They monitor, they attribute and measure risk. And one of my favorite assignments in my investments class is to have my students do that attribution analysis. We do it mostly with equity, although there's a really cool one you can do for fixed income that's a little bit more complex. Sometimes I do it, sometimes I don't know it. So we want to attribute it to, was it luck? Was it because we had good security selection? Was it because we had good asset allocation? Was it because of currency? I mean, there are a bunch of ways to attribute the compensation. And so we want to measure risk. So it's important for us to identify which risk measure we're going to use before we measure it, right? Do we want standard deviation? Do we want beta? Do we want exposure? What else do we want to do? And then we can go all the way back to level 2 and then all the way back to level 1 when we introduced, remember in level 1 we did that simple linear regression, and then we led up to factor analysis, then we did risk factor, we did the Fama-French 3-factor, we did all that kind of stuff so that we could understand those different risks. You see how this is all a part of identifying and quantifying, right? Quantifying, and then once we quantify it appropriately and accurately, then we can manage it. So how do we do this? We want to make certain that we compare our performance and our risk. So we want to compare the first moment of the distribution, the return, to a benchmark. And then we want to compare the second moment of the distribution, active risk. We probably call it standard deviation of something versus some kind of a benchmark. We need a risk budget in there. And that risk budget is going to reflect, we got the silos, right? And the correlation between and among the silos. So those risk budgets and the buckets that are thrown into each one of those budgets ought to somehow end up with the Harry Markowitz efficient frontier, where we're maximizing return for every given level of risk. Under private equity investments, let's see, we're once again back to the board. So that's going to ensure that the private equity returns justify the loss of liquidity. We talked about that. What was that, 30 minutes ago or so? Potential risks are often ignored. Yeah, this is really, really a good exam question where the Institute is kind enough to list some risks and say, oh, we're on top of this risk, we're on top of this risk, we're on top of this risk. And then somewhere in the question, they'll say, hey, is there anything that list of risk ignored? And you'll just jump on it. The Institute says, make sure you don't overlook currency risk. So that sounds like a really good asset. Really good exam question. How about the infrastructure risk management? We need to identify and quantify. We do all that. I've been saying that, right? Our risk team reports to all of the stakeholders. So we're going to hedge, we're going to rebalance, and maybe reduce commitments over time. That makes perfect sense. So what are the strengths? So this is the second part of this learning outcome statement. Coordinated risk framework, active participation, strong independent risk function, data provision, and training. Think about how viewing this as an enterprise-wide risk management system or structure. Think about how it adds information to the entire process. Guys, remember Newman on Seinfeld had a great comment about working for the post office. He said, when you control information, right? And he gives that evil Newman laugh. And so that's really what we're doing here, that the enterprise risk management system, what it does, it just adds information to our decision-making process. How about the weaknesses here? If we ignore or we discount ESG, what that's going to do is pose a hit to our reputation. If we ignore all of our stakeholders, and I have our students, we have the Bloomberg terminals in our finance trading lab, and I have our students just type in a company's name. You guys do I probably said this to you before, the supply chain function is really, really cool in there. So, you type in a company's name and it has all the supply chain people on this side, all the supply chain people on this side. And so we can see all of the stakeholders involved, not to mention, employees and all those other kinds of people there. So inadequate stakeholder engagement, scenario analysis inadequately. Yeah, this is why that we have algorithms and we have Monte Carlo simulation and we have all these kinds of algorithms that result in accurate stress testing. Inadequate climate risk due diligence. Yeah, there's just your homework assignment, right? Let's go out and make sure we know all about it. Lack of robust risk mitigation plan. So that makes sense. So what about these recommendations here as we're winding this up? So we want to improve, we want to enhance, and we want to develop. So what does improved due diligence mean? It just means to work harder, right? Just get the shovel out and go and work and make sure that all the dirt is over here where it's supposed to be. Enhance stakeholder engagement. This just means that what we want to do is we want to make certain that we're aware of all the people out there that we're impacting and go out and have a survey, go out and ask them, say, hey, this is what we do. What do you think of it? The most annoying thing that we have in our lives is when we make a phone call to some institution and they say, "Would you like to take a survey when you're done?" And I always hit no, of course. Develop detailed scenario analyses. Look at what we have in bold over there. Realistic assumptions. What did I say earlier? When I have my students, I haven't put crazy numbers in there that are unrealistic, because the way I like to teach is I like to teach through the extremes. Let's get an extreme answer on one end and an extreme answer on the other end, and then say, what do we do if we hit these extremes? And a lot of times there's not really an answer, but when you move to the middle, to the expected value, well, then you get realistic assumptions, realistic stress testing, and then you can make real decisions that are impactful. Then we can strengthen, and then we can create. This makes perfect sense, and that takes us through all of these LOSs. So what did I tell you? I want you to go and read through that case in there and read through the dialogue. I think that dialogue and the ending couple of paragraphs will really summarize all the stuff that we have talked about in this super long slide deck. So I apologize for talking so long, but that's what I do for a living, is talk. But I think, I can't remember, I can't guarantee, but if I'm creating an exam question here, I'm going to go ahead and put this sample dialogue in there and then ask you to tell me about what are the strengths and the weaknesses of that dialogue as they relate to all of these LOSs. So hey, thanks for watching. Thanks for your patience with me. Have a great day. And good luck studying.